In this video, we're going to talk about Lucid Motors, trading under the ticker symbol LCID. There are massive price movements coming out of the stock at the moment, and it would be very important to stay up to date with the latest price movements. In this video, I'm going to cover the technical aspects and how the stock performed over the recent trading sessions to identify what should be the overall approach with the stock. Fundamentally, the reason why Lucid Motors has always been one of the most popular stocks to trade for both institutional and retail traders is because the company is widely viewed as a potential competitor of Tesla, and a duckling allowing us to test the temperature of the entire sector, and also a trend maker for other smaller companies. This is why it's an interesting stock to follow up to, and it's a really important company to understand if you want to get into the EV sector. Lucid Motors is a startup based in Newark, California. It manufactures electric vehicles and specifically targets the high-end segment. The main appeal of Lucid is that it's based in the US and operates in the US, and is widely considered as a potential rival and an alternative to Tesla, at least a significant alternative. That means that for market participants who either want to hedge their exposures in Tesla or for those who believe in the sector in the long term, would be interested in investing in Lucid. Another appeal for investors is that unlike other EV startups, Lucid is a significant rival of Tesla based and operating in the United States, with little to worry about regarding the effect of remote oversight and geopolitical tensions. The recent catalysts have been focusing on the release of Lucid Air, a widely acclaimed vehicle from the critics, and may provide the company the capital to keep growing at a fast pace. The trading volume of Lucid Motors has recently been 22.5 million shares, compared to the average volume of 41.1 million shares. Over the previous 52-week period, its price fluctuated between $16.12 and $64.86. The market cap of Lucid Motors is currently at $45 billion compared to an enterprise value of $26 billion. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company, related to the current fundamentals, leverage, and asset composition. Some of the examples of the impact by leverage is if the company has a lot of debt, then the market may feel uncertain about the company's future, which in turn may negatively impact the profitability, attractiveness, and the solvency, and then impact the market cap, obviously. One key element to note regarding the enterprise value is that for many growth-type companies, one of the most significant assets they own is the goodwill. Goodwill is basically an expectation of the market that the company is able to generate more profit or to have more growth than other companies, partially because it may have a good management or better management than the rival companies, better brand recognition, and bigger online following. It's basically what makes this one company unique compared to other alternatives. So, in other words, it's not a tangible asset that companies can use, but it's often the reason why some companies are perceived to be trading at a discount. The market cap is often lower than the enterprise value because the enterprise value includes the value of all assets once the debts are paid off. In case the company goes to liquidation, though, there won't be any goodwill left, and the bondholders and the shareholders would have to do with whatever that is other than the goodwill. In comparison to its historical price fluctuations, the stock is 7.48% higher than the 1-month low. Same goes for the 3-month low and the 52-week low. On the options market, which often gives a hint on the market sentiment where the stock is going to go, the implied volatility is 107%, compared to a historical volatility of 89%. The put-call volume ratio is currently at 0.86. It's normal for most stocks to also tend to have a higher put option volume than what they truly deserve because many institutional investors choose to hedge their exposures systematically by buying put options. The most recent volume of options traded has been 129,000 contracts in a day, compared to the 30-day average of 266,000. In terms of open interest, the most recent volume of open interest has been 1.1 million contracts compared to the 30-day average of 1.2 million. So, regarding the shareholder structure, institutional shareholders own about 69% of the outstanding shares. The biggest shareholders include Vanguard, Franklin, and Blackstone. It's relevant to an extent to know these shareholders because it helps to determine whether you should be holding the stock long term or to view it as a short-term volatility opportunity. So usually the consensus is that in order to justify for long-term holding, there should be about 25 to 30% of institutional participation. This is obviously subject to a lot of exceptions because many great companies of tomorrow are currently owned mostly by retail investors as well. But that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes when there are significant short interest in the total volume, it can be a sign that there's organized shorting operations happening. The short interest is currently 16% of the total float, with 60% in the dark pool transactions. Now, let's also take a look at the indicators. So, financial indicators give us a sign of what the market sentiment is. The oscillators are showing 2 sell, 9 neutral, and 0 buy, with an overall tendency of sell. The moving averages of the past 24 hours show 13 sell, 1 neutral, and 1 buy, with an overall tendency of strong sell. Now, keep in mind that financial indicators give us what the performances of the present and the past have been, but doesn't tell us accurately about the future. Nevertheless, they can be relevant to determine if the timing of the trade is a good one. Regarding the pivot points, essentially levels of support and resistance calculated by an algorithm, the support levels are $12.25, $20.63, and $25.82. For the resistance levels, they are $31.40, $33.42, and $56.16. On Monday, the trading session began initially very strongly, reaching around $28.20 at one point before retracing back to below $27, for which the bottom of $26.40 has been reached before the recovery gradually took back the losses, finishing the day just below $27. It's actually interesting to see how the stock tested a third time the bottom of $26.50 before going back up. Overall, that is a sign that the selling pressure remains present, but the stock is now showing more resilience, and we should see the stock to begin recovery even more during the next couple of days. Perhaps a more worrisome issue, in my opinion, is that with Lucid, the fact that the entire sector has been pushed up so significantly over the past few weeks or month, and more so in the past years, give us the impression that reaching for new peaks requires a lot more demand from the market that it doesn't have at the moment. Of course, that's a discussion for when we get there. In the long term, the previous peaks have always kept going lower and lower as time goes, and this may be caused by the supply chain worries as well as the impact of demand if a recession actually happens, assuming that it may show up in the economy within the next 12 to 24 months. So we have to think about that as well. Personally, I think that the market overreacted over the past few weeks, and the participants followed the trend, which doubled down as a simultaneous sell-off of the growth stocks as well. Even if the market believes that Lucid and Tesla are no longer startup companies due to their long track record and their market cap, it didn't stop their stocks from getting affected. My assessment toward Lucid is now relatively bullish in the medium term, and I believe that entering in the stock now is a decent timing, as long as we make sure to keep the exposure from affecting the rest of the portfolio. Ever since the beginning of the month, the sell-off has stopped, and I think that now is a good timing to start having a position in the stock, at least based on the recent price action performances. As for the allocation, my suggestion is to keep a maximum exposure of 3 to 5% of Lucid stock in your portfolio, and it would be a decent moment to start building up a position since the price level is sufficiently low at the moment. Your investment should also take into consideration the market conditions and the surrounding sentiment to determine what kind of asset should be picked, for how much and for how long. First of all, the financial market doesn't reflect the real economy. If the stock market is doing great, it doesn't necessarily mean that companies are hiring people, that salaries and living standards are rising. Sometimes it's the exact opposite that happens, because the stock market is a pool of money where things come in and come out, going to different sectors to be placed. The capital may be used to be invested in a company to improve its efficiency and productivity, but it can also be used to buy up shares and assets in order to make a profit. This phenomenon is called financialization, and it means that the more money is being used for non-productive purposes like merger and acquisitions, fees to financial sectors, buying back equity, and so on, the less there is for the real economy. Another way to put it is that ever since 2008, the Dow Jones has increased significantly. But people don't necessarily see this growth in tangible ways. This is why we gotta be careful with the assumptions that rising stock price means better outlook for the company. Sometimes it doesn't mean anything other than the fact that the asset is getting more expensive to be bought and that their yields is going down as a result. Additionally, some new phenomenons are now palpable, such as the creation of new bubbles, the participation and influence of retail traders in specific situations, and the anticipation of a massive recession or at least pullback. Bubbles have always been created on and off over the past few centuries, but nowadays it's quite interesting to see the speed at which an organic bubble can be created back in 2020. Because almost immediately after the major collapse of the financial market back in early 2020, the market decided to pour a massive amount of capital in the EV sector and anything that's related to it. Stock prices went up the sky, and for a moment, it really felt like any EV stock can be a golden goose. Another way to say this is that any SPAC with an EV company in it will become the next Tesla, right? Even if it didn't last that long, this episode definitely allowed the market participants to park a lot of their money in a sector, leaving it with either a lot of profits or at least avoiding incurring large losses because they left their money in the blue chips or the sectors heavily affected. The involvement of retail traders in companies has also been much more pronounced in recent months, especially in the scenarios of a short squeeze. Companies may have short sellers who believe that the stock will decrease in value. The short squeeze consists of buying the stock price up to force the short sellers to recover their positions, which will then also trigger an even bigger increase of stock price as a result. Of course, I'm not saying that this is always rational. I'm not even saying that those companies always have a convincing narrative. So, for example, if you play video games, ask yourself if you personally bought all your games at GameStop, knowing that you can buy the same games just online in the comfort of your home. But nevertheless, retail traders do have a much more significant influence in the stock price nowadays, for the better or worse. Personally, I think that as long as the volatility is high or gets higher, it'll create more opportunities. The final phenomenon is the anticipation of a recession. Many people have been expecting something of that sort to happen ever since 2008. There were quite a few companies that were supposed to go bankrupt because their debt structure is no longer sustainable or that their business model is bad. But overall, the system was able to hold its ground, especially in the North American market. This is partially because capital around the world often choose to come to the American capital market when things get heated back home. This is especially the case when geopolitical tensions increase around the world. In order to make sure that capital can provide a steady return without being affected too much by the central bank policies and inflations, I think that this phenomenon will increase its pace as time passes by, at least for the next couple of years. This is why we will likely see the blue chips continuing their ascension, even if for the growth stocks things may be a lot more nuanced. The bottom line in all this is that the environment is getting more uncertain and volatile in a context where asset yields will probably remain quite low, because the real economy cannot be improved with just money. As far as we're concerned, this means that the patience would be a great virtue for all of us, and that there will be plenty of opportunities to eye for better prices. With that being said, always make sure to keep your positions diversified and keep the risk level under check. Speculative positions should play a small part in your overall portfolio. I would say it's better to keep them below 10 to 20% of your total holdings. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.